Kaine from Synthetix. I'm here with Marouane from Unslashed, and I'm here with Barney from Vega Protocol. So what I want to do today is kick off with some short intros. I will start with myself because I want to give a little bit of context to what I'm trying to get out of this panel and what we're trying to achieve. But basically, what we want to try and achieve today is.
Are you getting that notification?
Yeah.
Yeah.
I don't know from where it's coming actually.
Yeah, I think it's all good now. But I don't have my messages. But if Bryce sends us something saying something's not working, just give me a heads up because it's hard to multi. Cool. But anyway, so I'm very excited about this panel because some of you might know that I'm one of the founders of the Melon Protocol. We are an on-chain, completely decentralized asset management protocol. And so we actually look to integrate a lot of the kind of products that are being built by the people that are here today on this panel. And it's actually on our roadmap to look at every single one of you in the next coming months. So for me, it's very exciting to be able to sort of use this opportunity to deep dive into your protocols with you. And I'm very happy that we have the time to do that. Because of the length of this panel. So before we begin, I'm just gonna let you all give quick intros on yourself. I know that I'm pretty sure most people know who you are already, so we can keep them relatively short. And then I think we're gonna spend the first 15 minutes kind of looking at what it is exactly you each are doing. And then we're gonna use the rest of the time to deep dive. And I believe there's about half an hour at the end for anyone who has any questions. So Kaine, why don't you go first?
Great, okay. 1 second. Cool. Sorry, I had Telegram open so I could see if Bryce was sending any messages to us. So I'm Kaine from Synthetix. Synthetix is a synthetic asset issuance platform on Ethereum. So we allow people to essentially get access to price exposure of a range of different assets on Ethereum. So that includes Forex, like synthetic dollars, GBP, Euro, AUD, etc. Commodities like gold and silver, as well as a range of crypto assets. We also have a number of upcoming asset classes that we'll be launching, like options, as well as futures, and leverage trading, things like that. So we're, I guess, a little bit different to a bilateral trading platform in that, we use a pooled liquidity model similar to Uniswap, where people stake and add collateral to a pool, and then people trade against that. So it's a slightly different model to what you might be used to in a futures exchange or a spot exchange, but it's allows people to get access to liquidity, very deeply without needing a counterparty.
Great. Marouane, maybe over to you.
Sure. I'm Marouane from Unslashed. Basically, what we're doing is we are building an insurance protocol on the Ethereum blockchain. So we allow people to underwrite risk or buy insurance by having a marketplace, an insurance marketplace. We are going to cover a lot of different risks, mostly blockchain-related risks. We're leveraging the Melon Protocol, actually, in order to allow people to manage assets while underwriting the risk. And it's cool to be with you here, guys.
Awesome. And then Barney, maybe over to you.
Awesome, thanks. So hi everyone, I'm Barney. I'm one of the co-founders of Vega Protocol. I spent the beginning of my career sort of building trading platforms for, I guess, the traditional financial markets and working in that environment with investment bankers and exchanges. And what we're aiming to do with Vega is two things really. Firstly, to make sort of derivatives available in a decentralized way that have what I would call product parity with what's available in the traditional markets, so making sure that actually we have a very sort of complete set of derivatives that do not trade the functionality that traders and sort of hedgers and risk managers need from the products. They don't trade that away in order to be decentralized. And then the other thing we're aiming to do is to have fair and liquid markets that work in a decentralized way. So a big part of our protocol is actually around incentivizing liquidity, so that in addition to potentially sort of passive or automated market making, we actually have strong incentives for people to come and actively provide prices and liquidity into our decentralized platform.
Awesome. Very cool. So we're going to start off. I'm going to ask you each to answer a very simple question, or at least should be a very simple question for you, so that we frame, the topics we're going to talk about in the next couple of hours. Kaine, in very simple terms, what is a synthetic product?
So I think synthetic assets in our context are essentially assets that are giving you exposure to some price feed, essentially, right? So in the case of, say, synthetic gold, you've got a token on Ethereum which tracks the price of an ounce of gold, right? So there's no underlying asset that's being held. We don't store gold in a vault somewhere. It's just purely based on a price feed that allows you to hold that token and track the price.
Okay. And Marouane, in your very basic definition, what is insurance?
Insurance, I think, is something that we are pretty familiar with. So basically, it's the ability to have a protection against an event with one simple outcome, which is basically either one loses or nothing happens.
Okay. And Barney, I guess, what is a derivative? I know that Vega and Synthetix are both more than synthetic and derivative platforms. We will get to that. But, maybe you can just give a very basic definition of what is a derivative.
Absolutely. So a derivative is effectively, the technical definition is that it's a product that's price is derived from something else. So it's the price of something else or an event that happens or some other piece of data. But what that really means is that it's a way of unbundling risk and moving risk around. So we're all naturally, if you like, long or short certain types of risk. Like whether it's, you're a farmer and you are exposed to the weather and the price of the crops that you create, whether it's that you're exposed to currency fluctuations because you import and export, or even just aspects of your daily life where the price of your house might have an impact, or the interest rate has an impact on your mortgage. We're all exposed to all these risks, and traditionally you own a house and you have a mortgage, and now those are the risks you have, and you don't have a lot of control. Or you own a farm, the weather is something you have to take, as is the price of the crops that you create. And the concept of derivatives is really simple. It's just saying what we want to do is package up and unbundle those bits of risk so that I can say, I don't really like being exposed to the weather because I can't control it, and I'm really just interested in being a good farmer. So I'm going to sell that risk of being exposed to weather to someone else, either who has the opposite exposure or who professionally, and by taking a spread in how they price it, they make the money that way. They professionally take on that risk for me so I don't have to. And that's incredibly beneficial in society, because it means that instead of every farmer and every importer and exporter and everyone having to maintain this sort of huge buffer of capital in case one of those risks cause them a large cost, and what they can do is they can know up front that I can say, I no longer want to be exposed to that risk, or I want to take exposure to a different risk, and that's going to be my business model. And then they can trade that risk with someone else. They can know the price of that risk. They can hedge effectively, is what it's called in derivatives. They can hedge that risk, and they can give themselves more certainty from a business perspective, and give themselves better sort of efficiency from how they use capital and how they operate their business.
Okay, fantastic. So we're going to stay on you for a second, Barney. So now I want to just go into Vega Protocol a bit deeper. So my understanding is Vega Protocol is a protocol which enables anyone to set up a derivative of any kind and make a market in that derivative. And you provide the tools, risk management, and all the functionality around that. So what I'm interested in hearing is how this protocol works, how you think about risk management, and how you align the interests between the different stakeholders in the system.
They are the key questions. So the protocol works on the basis that in order to do the risk management, you effectively need to do one of two things. You need to do what we just talked about, which is remove the risk. And there are different ways to do that. There are some, for instance, some sort of more trivial derivatives protocols that I've seen where they have, say, they issue an option and they simply make you lock up everything that you might have to give someone under that option. You know, if I take an option where I can buy something, you know, buy 200 of something for $200, then they will have to lock up those 200 of something just in case they have to pay it out. And that works because it means that the option technically is going to work for me once I bought it, but it's unbelievably capital inefficient and it gives you a problem. So what we've done is model it more on how these things work in sort of the traditional markets, where a lot of research has gone into making this work well. And effectively, the network needs to warehouse the risk. So the network needs to make sure that it can operate. It can operate well. And the first thing it can do is net off the risk. So if if a bunch of people go long and a bunch of people go short, then all other things being equal, they're going to pay each other off. And so then there's the remaining exposure. And what effectively needs to happen there is the network wants to be able to know that it can understand the amount of risk someone is in and take an appropriate amount of margin off them. So we take some of their capital, not the whole amount they might have to pay out, but the amount that we think their position might move against them in a given amount of time. So let's say we're looking at the next 10 minutes. If we have enough capital that we know that within 99.99% probability based on the market data we have, it's not going to move against them by more than a certain amount, then we might add a buffer onto that amount to make sure we've got that much capital. The other side of this is liquidity, and liquidity is super important because if I have enough money to look after your position for the next 10 minutes, but in 9 minutes' time it turns out that it started to go bad, then what I need to be able to do is say, well, how do I close you out without inconveniencing the person who you traded with? And that's where liquidity is super important, because obviously if I just close your position, then the other side of it gets closed. They're going to be super unhappy that they no longer have whatever position they've taken out. So the way that Vega deals with that is that it says that we have a very strong incentive mechanism built into the protocol. We call it an owner-operator like market maker incentives, which is to say that not only do market makers receive a share of the fees on the protocol itself, so rather than the fees going to us as an operator, actually we're not an operator, it's a decentralized protocol, so the fees are shared by the market makers. And the earlier they join a market and commit to a market, so the more sort of risk they take in starting a new market and taking on the risk of putting up something new and growing it from a small market, the earlier they join, the more of the fees they get. Those market makers get that fee, and there's a sort of target level of market making commitment for every market. And so that target level is designed to mean that if the commitment level is at the target, there's enough liquidity constantly available on the order book that if someone does end up failing to keep up their margin calls, then the system can close them out no problem, and back to back the other counterparties. In fact, everything's sort of back to back with the network really, so everyone is trading with the network, but the system can close it out and without any major net risk imbalance. And so obviously it uses sort of sophisticated risk models, relatively simple stochastic models for futures, and then obviously sort of things based on the later incarnations of stuff after Black-Scholes for options, uses those models to work out the amounts of margin it needs. And then the final part of this whole picture is that this is all probabilistic, and so you do have that chance that you move, that jump in that 10 minutes is bigger than the amount of money you had. That's always possible. There's a risk of market gaps. And the way we deal with that is we basically say, well, if you don't meet your margin calls and we have to close you, we're going to confiscate any of your margin that's remaining. And again, we calibrate that so that 99.99% of the time we close you while you still have some margin remaining. We confiscate it because you were badly behaved, and we put it in an insurance pool that belongs to that market. And then what happens is when someone ends up being the 0.01% of the time where the market gaps further, then we are able to access the insurance pool that sits there on the market in order to make good the other counterparties. And ultimately, if you get to a point where none of those things work, like it's a very new market or it's super volatile or really badly specified, then what will eventually happen is that there won't be money in the insurance pool and there will be a form of loss socialization. But over time, one of the interesting things is if you calibrate these numbers right statistically, if you've got one market, there's a risk of that happening. If you've got 100 or 1,000 markets and you calibrate it well, you can calibrate so the total insurance funds in the network grows over time, and you can redistribute those insurance funds to new markets. So eventually you get to the point where new markets are well protected from the get-go. And just the sort of final closing thought on that is that there's two problems with letting people create their own markets. One is the kind of what I would call the ether delta problem, which certainly in the early days of ether delta, when you looked on those decentralized exchanges, you can theoretically trade any of 1,500 things with any of 1,500 other things. but how many of those have any liquidity to speak of at all? So that's not a good experience. So you don't want to let people just go crazy. And then the other problem is that some of the aspects of creating a derivatives market require thought, like how do you calibrate those risk models? How do you set the parameters to make it actually work? And so as a result, markets that can be proposed by anyone, but they're only created once they are kind of supported by the network's kind of participants, token holders who have the governance, but also supported by market makers. There's effectively it's a bit like a Kickstarter. There's a market making target. You can propose it, it's going to sit there in a pending state. And when enough market makers are saying, this is a good market and it's well specified, and I think it's worth my while committing to make prices in it, for a period of time, committing to make prices in it because I think I'm going to make money doing that, and I think it's well enough specified. When you get enough of that commitment, then you can say, we can safely list this market on the network.
Okay, that's very interesting. So this is very interesting. So I'm going to try and repeat back to you in simple, short terms what you've just said. So correct me if I've misunderstood anything. But what Vega does, it allows anyone to propose a market in any future derivative whatsoever, define those parameters, the expiration, etc., etc. And then propose it to the community. The community then takes a vote on whether or not that market should be allowed to enter the Vega Protocol system. And is it compulsory that market makers have to already be backing this before?
Yes, absolutely. So in order to run a market safely, you need market makers. In the future, there will likely be potentially with a sort of a backing of capital, sort of more like a DAO type of system where you can have request for quote style markets where you kind of have more bigger service providers writing contracts, but in this initial case, it's all kind of exchange traded and it relies on market making commitments.
Okay, so you've sort of somehow given some kind of minimal guarantee that you're going to have liquidity there to start, which prevents you from having thousands of markets which nobody is trading. And then you have this concept of dynamic kind of fee sharing, whereby you're rewarded as a market maker for the risk you take. So the less liquid or the earlier you get in, the higher your reward is some kind of share of the network fees, if I'm not mistaken.
That's absolutely right, yeah.
Okay, so and so that's pretty much the setup of Vega. The one thing actually you mentioned, I thought it was very interesting, and I don't think I've heard about this concept of netting off, or at least I haven't heard of this concept of netting off positions very often discussed in DeFi. I think that's definitely a very capital efficient way to do things. But how do you the sort of margin requirements, I guess, are changing on a very live basis. How do you sort of lock that in or ensure that, let me take an example, like a real life example. If I realized that I was suddenly losing a ton of money on a position, and what's to prevent me from transferring out the funds in my wallet before Vega Protocol seizes them from me?
Absolutely. So we have a number of levels in our margin system. So our margin system is kind of near real time. Margins get reevaluated and kind of in close to real time. And what we have is the maintenance margin level, which is a pretty standard concept in trading, which is if I don't keep this amount of money in my my margin bucket, margin account, if you like, for this market, then my position will be closed. And the money that's in that is kind of locked up. So that is kind of like when you lock money in a token contract, it happens a lot faster because Vega's a sort of a blockchain of its own, which we can go into later, which has a sort of one second block time. But that money is locked. Each block each transaction actually even within the block is locked in that account. And if we can't get enough to meet the maintenance margin from your kind of general account, which you can do things with, then we will close your position.
Right. And at what point does the insurance kick in, or is that?
So let's just go through the other margin levels, then I'll touch on insurance after that. And so we have sort of three levels in addition to that, which are important. We have what we call the search level, the initial level, and the release level. And the initial level is the level which we aim for. So when you open a position, that's how much money we're actually going to take. So if the margin requirement is 100, we might take 120 out of your general wallet, because what we don't want is to constantly be moving money back and forth. We want some buffer in there. So we'll take, say, 120. If your position goes in your favor, we actually real-time mark-to-market the position as well. So if the position goes in your favor and the margin balance, the total balance becomes, say, 140, that might hit the release level where we say, actually, we will put 20 of it back in your normal account so you can access that 20 and return you back to that initial level. Equally, on the other side, let's say it gets down to 80. What we then say is, well, the initial was 100, 80s maybe the search level, and maybe 60 is the maintenance level. So if it gets down to 80, that's where we say, right, well, we're getting closer to that maintenance level. So what we're going to do is we're going to go back to your general wallet. We're going to transfer money into the margin account to be locked up so that you're back at the initial level and so that you're out of the danger zone. If you transfer all the money out of your wallet and so we can't search, and we search and we can't find, there's nothing left in your wallet, you don't want to do the position, then you're in the margin call zone really at that point. And if it keeps going against you and you get down to that maintenance level of 60, your position is liquidated. So that's how we manage those. The insurance fund kicks in when we liquidate the position. So let's say it's gapped through, it's gone down to 50, and we liquidate the position. If there's 50 in your margin account after we mark to market your position and we liquidate it, everything's happy because actually you've still got 50. You're not at zero, so we can take the 50 as the penalty for not meeting your margin call and put it in the insurance fund. But let's say something crazy happens in the market, or it's a very leveraged position or something, and actually your balance after mark to marketing would be minus 10. Now we have a problem because someone somewhere is owed 10, and we only had whatever was in there after the last minute, so 60 or 50 or whatever. So now what we need to do is say, well, how do we find that 10? And that's where the insurance pool comes in, where we say, well, we've been topping this up every time we close someone who has not met their margin calls, so we need to find that last 10. We get it out of the insurance pool and make good the other participants to make sure that as far as possible, everyone is making the right amount of money and no one is losing out.
Interesting.
Just to make sure I understand, is Vega focused only on crypto, or are you going to do a lot of different derivatives?
Yeah, absolutely. We're not really focused on crypto. In fact, one of the ways that one of the drivers for creating Vega was this feeling after spending a lot of time in the financial markets that a lot of people were making a lot of money doing not very difficult things because they were in a very privileged position in the middle of everything. They could create markets. They were in with the regulators, in with the big banks. And when you look at the cost to a sort of small business, for instance, of taking out some of that kind of hedging I talked about when I talked about derivatives, the layers of fees and spreads that get added between the market price and what they are paying is insane, given that actually the only one doing any work there is really the guys who set the price in the first place. Everyone else is running a web server. And web servers, I don't know if you look recently, they cost like $2 a month. You can do thousands of transactions a second. So the level of fees that people get shafted for is really crazy. And not only that, but they don't get, creating a market is hard. It's not available to the community. It's not available to most industries and most countries and most cities. So you have this problem where you can't probably get the exact product you want. So you end up with an imperfect proxy hedge. You're taking out a product that's kind of similar to the thing you want to hedge against, not the actual risk. And then you pay all these fees to do so. And so really one of the reasons we created Vega was this idea that if the people using it run the infrastructure, and we take away all the layers and we give everyone the same access and same ability to propose and create markets, that would be super beneficial. And so, whether it's allowing people to hedge currency risk, whether it's weather derivatives, whether it's whatever they come up with, I'm super, super keen on it. And I'm really, really happy. Actually, when we started Vega, there were lots of pieces still to be built, on-ramps and stable coins and all these things were kind of really only just starting or not very clear. And since we started Vega and been building this, everyone else has been diligently away building all of these other things, much better wallet UX, much better on-ramps for fiat into stable coins, much better stable coins, much better, more audited, asset-backed stable coins, interesting types of algorithmic stable coins, all these different things, asset-backed securities, everything. And so now what we're finding is that by the time we launch Vega towards the end of the year, we're likely to have a really much closer to complete ecosystem of things that can plug together to make Vega useful for people who don't have their crypto hat on and are not sitting on enough ETH to retire to a small island somewhere. And
that's a very interesting observation. We felt the same with Melon. When we set out, there was sort of Oasis DEX. 0x came after as a DEX, and and I think there was Augur. But some of basically DeFi was in its infancy, and the kinds of things you can now integrate and imagine for this ecosystem to be much more complete are all falling into place. That's one of the reasons I was so excited about this panel. Anyway, we need to move on time-wise. Kaine, can we move over to you next?
Yeah, no, it's okay. It's 9:30 at night, so no, my daughter just woke up, so she's okay. She's used to it. She's used to late night calls. No, it's okay. It's fine. She'll just hang out. All good.
Okay, cool. So maybe you can walk us through kind of how Synthetix works. Again, I'll sort of start with my understanding and my very basic understanding, and you can sort of fill in the gaps. But my understanding is anyone is able to create a synth on Synthetix. In doing so, they have to stake their Synthetix tokens, and then I guess not too dissimilar from Vega Protocol, there's also this marketplace, or there's this Synthetix exchange where synths can be traded, actually, we can talk about counterparty later, but they can be traded on this exchange at market price, and basically the collateral which is staked provides that liquidity. Is that correct? That understanding so far?
That's correct. Yeah.
Maybe you can sort of go into a bit more detail about how that works and kind of how the stakeholders are aligned within your ecosystem.
Yeah. So it's I think what Vega and UMA and some of the other derivatives platforms are kind of doing is a different. Maybe more comprehensive approach, right, to derivatives than what we're looking to replicate. So this idea of being able to handle the long tail of assets, right? We're probably closer to like a Uniswap pooled collateral model, and the idea behind that is essentially to short circuit the user experience side, right? So that someone can turn up and instantly get access to a bunch of liquidity, right? But the trade-off there is that the markets that we can support are more constrained, right? So we can't have super liquid markets because the way that the system works is essentially it's like a decentralized clearinghouse. So a whole bunch of people get together, they lock collateral in the form of SNX tokens, and they mint the synthetic assets, right? Synthetic US dollars. And then anyone can purchase those synthetic US dollars, and they can convert them at the current price that's published on chain via our oracles. And at the moment we use a mixture of Chainlink and our own centralized oracle, but we're moving over to Chainlink oracles. So eventually Chainlink will publish a set of prices for all the different assets that the system supports, right? And at the moment, that's about 40 different assets. And you can turn up, and if you're holding synthetic US dollars, you can convert that into synthetic euro at the spot price that's published, by that oracle. And so, the trade-off there is obviously that we can't have super exotic derivatives, right? We need to be limited to, fairly liquid, large-scale markets.
Right. So you said a couple of interesting things there that I want to dig a little bit deeper into for my own understanding. First of all, you likened Synthetix to a clearinghouse. So maybe I want to spend a bit of time on that. So a clearinghouse in traditional finance is basically an organization which ensures the settlement of a trade, right? In your model, I come in, I want to buy, let's say, I know it doesn't exist, I think, today, but let's say I want to buy some Apple synths because I want exposure to Apple in tokenized form. And let's say that Apple is trading at, I have no idea where it's trading. Let's say it's
$300, yeah.
let's say it's trading at $300, right? So Synthetix Exchange is offering me Apple synths at $300, right? And I now own an Apple synth. Fantastic. And I'm now exposed to this exposure. Now, that means that the Synthetix platform is short Apple exposure because it just sold it to me, and I'm long, right? So walk me through. So Synthetix has an open short position, and I'm interested to know how that risk is managed and how and where the clearinghouse part comes in.
Yeah, so Synthetix itself is not short, right? The stakers who have put up collateral are short, right? So all of the people who've kind of come together to add their collateral to the pool to be the counterparties to all of these trades are the ones that are short, right? And so the idea is that those people who are providing this service, who are kind of coming together to form this pooled counterparty are the ones that need to hedge their exposure to that position, right? So if there were a bunch of people that were long Apple, then in order to hedge your exposure to that, you'd need to go out to the spot market and essentially hedge that exposure as a staker, right? To make sure that you remain neutral to whatever the current sort of constituents of the debt pool is.
So people who stake their synth tokens, the risk management of their exposure is on them.
It's on them, yeah, exactly. Yeah.
Okay, understood. And is there a way to easily measure that risk exposure on the network?
I mean, you could, it's on the Ethereum blockchain, right? So you can kind of look at any time.
No, I mean, do you have like a visualization of the?
You just get in and you read the mempool and you run your full node, and it's very simple. I mean, there's different tools that are kind of available to measure what that kind of skew is in the market, right? But ultimately, what the expectation that we have is that the people who are staking are in competition with one another to hedge their risk as efficiently and effectively as they can, as cheaply as they can, right? And they're just offering a service to the people who are trading these synthetic assets.
Okay, so the other idea I wanted to, that's totally clear now, thanks for that. The other idea I wanted to explore is you likened the platform, I know it's not exactly the same, but you drew the parallel between Synthetix Exchange and Uniswap. So Uniswap, so I agree, so I get that from the point that the collateral is pooled, and I think that's a very pioneering model in the sense that market making is an activity that requires huge balance sheets. So to sort of stimulate that liquidity, it's a great idea to pool liquidity. It's amazing that no one really thought of it before. I guess the banks have enough. So, so in that sense, it's great. But the one thing that I think Uniswap has that Synthetix doesn't have, unless I've misunderstood, is that Uniswap will skew a price according to the volume according to the volume available in that liquidity pool. So let me try and rephrase that better. That was very poorly. Basically, the bigger the price you're asking for in terms of volume, Uniswap will make that substantially more attractive to the buyer or seller, such that it protects its own balance sheet as a result, right? So the bigger the price it's making, the wider the spread, and therefore the lower the risk or whatever. But in your case, are you saying that the Synthetix exchange will always make the spot price regardless of the size?
Correct. Yeah, it's only constrained by the total size of the person's position or holdings. So I think just to clarify, when I said it's similar to the Uniswap model from a user experience perspective, right? In that you can kind of turn up and trade against a contract and not wait for a counterparty to be there, right? Or have someone match your order. So there's always a price, right? Now in Uniswap, the price moves. In Synthetix exchange, the price doesn't move, right? It's only limited by the assets that you have. But essentially, for a user, solving the kind of the user side of the network effects, right? So that you can always turn up and know that in this venue, I'm always going to get a price.
Okay, and how much SNX is staked as of today?
In total value, it's about 120. Yeah, dollar value about 120 million.
Okay, cool. So, so that means that, and what's the collateralization ratio? Is it was it 600%?
800%.
800%.
800%. Yeah.
So 1/8 of that would be the maximum size anyone could ask for a price in.
Yeah, it's about 17 million at the moment. in total since. Yeah.
So in theory, like if somebody were to come in and say, I want 16 million of asset X on Synthetix exchange, would really make that price? Wow. Okay.
Yes. Yeah.
So that's interesting. And how's your experience been with kind of the stakers and their risk management, methods and stuff?
Yeah, I think one of the challenges that we've had is that the majority of the people, certainly up to now, have been stakers themselves that have been trading on the platform, right? We haven't got to a point where I think it's differentiated enough to bring in external traders who are maybe a more representative sample of long, short skew. So what we found is that irrespective of the direction of the market, most of the people are fairly long biased. Even when the market's tanking, they're just jumping in and going longer. And so I think that it's not that hard to hedge the current exposure, right? Because a lot of it's just long ETH, right? So all you need to do is hold spot ETH, and you're pretty well hedged. But over time, as we add new assets and have leverage and other asset classes and other products, it will get harder, and it will take more sophisticated participants to kind of step in and take that on. And I think maybe the less sophisticated players will either need to improve or potentially delegate to someone else to stake for them.
Okay, awesome. Cool. Well, we'll come back. So there's a couple of ideas I want to dig into, both on Synthetix and Vega with you guys, but we'll come back to that. One is kind of the similarities and the differences, because I actually see, Vega is maybe going for the more long tail, but I think there's some interesting differences between the platform that would be interesting to discuss. And I think that, and Barney, you mentioned something about the fact that you were building on a different blockchain altogether, and I want to dig a little bit into that. And also, both of you maybe talk, to talk a little bit about the price feed sources that you're using. Well, Barney, in your case, to manage risk, so very sensitive. And Kaine, in your case, to make markets. So we'll come back to that. We'll circle back to that. But in the meantime, Marouane, I'm gonna kind of change topic a little bit now and jump to insurance. So you have a very interesting background, because you're, I guess, in finance background, but also obviously building an expertise or have built an expertise in insurance and launching one of the first insurance protocols. I've often wondered why we haven't got more insurance in DeFi. The assets, the assets kind of at stake on these very new protocols is frankly quite scarily high. And I often wonder whether, we can actually scale, to when I say high, I'm talking under $500 million. But if we really want to scale DeFi, we're looking at much bigger numbers than that. I don't know if that's possible without viable insurance solutions. But before we talk on that, maybe I've personally noticed in the last few weeks there seems to be the word insurance being used like quite loosely in DeFi, and I've heard it used in the context of options as well. I would kind of like your perspective on why we haven't seen a sort of scalable insurance solution in DeFi yet, and maybe clarify some of those misunderstandings and definitions that people are, or at least I'm seeing in the space.
Sure. Well, I actually there was a risk that started like in 2016. But they were like more focused on real world risks. So the first product, I think it was flight delay insurance or something like this. But in the meantime, what happened is that we didn't see any real insurance products take off. and the word is used or misused in a lot of different ways. So insurance is more like a tag word that we are putting on a lot of different products, while in traditional financial markets, we use another vocabulary. So for options, we are going to say hedging rather than insurance. So insurance is more focused on pure risk, operational risk, and there is a lot of it in DeFi. So if we think, for example, of what happened with Maker, the $0 CDP liquidations, this is more like an operational risk. This is something that happened due to the congestion of the network, mixed with the bots which weren't working as expected, mixed with a lot of other conditions that led to a loss for people who were having these CDPs liquidated for $0. If we think also of the oracle risks, having an oracle, we were talking about the oracles 1 second ago, having oracles that are going to bring prices which might be false or not the right prices to different platforms creates a lot of risk. So all these risks are there. I mean, we are trying we are building a platform to allow to protect them, but so far no one is really taking care of them. And so far it seems like this year we started really understanding that there is a need of risk management products. There are financial risk management or speculative risk management products out there. We need more of insurance, operational, default risk, pure risk products, and this is what we are building.
Right. Okay. So you're making the clear distinction here that options are used as portfolio hedges, and insurance is used for specific systematic events, some of which can be, by the way, parametric, i.e. easily definable, yes, no, or binary, and others which are harder to assess, like, an earthquake caused X damage. Who's going to decide what damage, how much are the liabilities, what's the process around that, and I would say the first is obviously the much easier one because, a binary event is obviously much easier to judge, but the other definitely has much more scope for debate, let's say, and obviously also takes a lot longer to settle. So I know that Unslashed is still in stealth mode. So to whatever extent you can, share with us some hints or thoughts on the space or what you think is missing for scaling it. I would love to hear, hear a little bit on that, and also kind of the timeline, for when we can expect to hear updates on Unslashed and the first products.
Yeah, well, actually, there was an interesting point. We started by focusing on slashing risk for POS blockchains. So we're really focusing on this binary outcome type of risk. And while building Unslashed, we understood that we had between our hands a protocol that could work for any type of risk. And what's really missing in this space is really to find the good product market fits and to have the right approach towards the users. Who are the users who are going to be using this product? Why do they need this product? And what the product is going to allow them to do. So when we are talking about different DApps that have a risk exposure, different types of risk exposures, we need to work with them in order to understand their needs, in order to figure out what type of product makes sense for them, and in order to be able to build something that would make sense for them on one hand, and also for the people who are going to underwrite the risk. So this was our whole approach. And this approach led us to start with slashing risk, but over time, while discussing with different teams, we understood that there were other markets in which there is a need for insurance, and which is not covered. Basically, it's easy. The final users understand the risk after the event happens. Most of the time, people building the protocols and apps know that there are a certain number of risks out there that need to be mitigated. And honestly, personally, I have this way of looking at things and seeing where it can break pretty easily, which leads me like to identify a certain number of risks and try to understand how we can mitigate this one, what are the correlations of between the different risks, and how we can build a system that allows to cover as many risks as possible.
So that's great. One last question before we move on. You mentioned about the quantification of risk, and I think that's fascinating. How do you approach the fact that, and if you can't talk about it, that's fine, but how do you approach the fact that we just simply have a lack of historical data to analyze in DeFi just because of how new everything is?
Yeah, well, our approach is pretty simply. I accept it, and basically the approach that we have is that we say that everything needs to be fully collateralized. Otherwise, we are somehow gambling with people's money. Like if someone comes and buys a cover which is not fully collateralized, in the case of DeFi risks or blockchain-related risks, it's going to be simply gambling. Like if there are sets of events that lead to sets of payouts, there are some people who are not going to receive the money that is owed to them. So this is like a responsibility towards users, and this is very important.
And I guess your vision is, as we have more historical data, then the collateralization level can drop.
Exactly. And
how many years of data do you think we need for accurately?
A lot. But basically, the interesting point when starting with slashing is that it allows to have a lot of different data. Like if we take a couple blockchains or POS blockchains, we'll be able to have like hundreds and hundreds of validators that would have their risk on our platform directly. So this allows us to start having data pretty early on. It's somehow different from, there are going to be like thousands of validators on E2. There aren't like thousands of the apps that are active in DeFi, so we need to start in a place where there is this kind of diversification that allows us to start somehow model the risks pretty early on. Mm-hmm. So this is our approach. Like start where there is diversity and then expand where there's need but maybe less diversity. And this is also something that's, when Barney was talking about risk management, I was thinking of how do you manage the fact that when things go south, everything is correlated. Like when the S&P loses, 30% in 1 week, everything becomes correlated. The BTC follows on, everything is correlated. So how do you approach this? Like it's not easy from a risk management perspective, and even banks are not like able to do it correctly.
Yeah, that's a good point. And when I talked about the kind of liquidity incentives, the upside for the market maker is that they receive a share of the revenue. The downside for them is that they're committed via a bond that they actually put up with the network to providing liquidity at all times. And so effectively, although things might go south for every trader, unless all of the liquidity providers on that market effectively trade through being slashed for their entire bond, then they're going to continue providing prices and try and get them right. And they might widen the spreads there. They can look as market makers to widen the spreads and things like that. But effectively, what we're doing is requiring them to sit there as this market falls and provide prices that allow people to get out. And some of the people, obviously the network is net zero, so the network's not winning or losing money. It's the people in the market. And so if you can have enough liquidity to make sure that both sides can be marked to market and can be settled correctly, then it doesn't matter how far it falls. It's only important that there's enough that liquidity, the bond, the value locked up in that bond is enough that the market maker does not decide, screw this, I'm going home, and simply, like, when they maybe keep providing liquidity until their bond gets eaten through and there's nothing left. So, the sizing of the bond and how we calibrate that, and even as we evolve the protocol, thinking about market-based mechanisms to actually drive the correct ratio between the bond and the liquidity commitment that someone makes, and how those things interact with risk. A big part of research now is getting that stuff right.
All right, but you're talking about a bond. It means that you're using a native token, right?
No, this is in the currency underlying the market, because you don't correlate to some native, not some token.
Okay, all right. That's interesting. Makes sense.
This topic kind of it's one that's actually very dear to my heart, and it's a nice segue into the topic that I wanted to move to next. So yeah, I agree with you, Barney, that anyone, any market maker's duty normally is to make prices regardless of the situation, and it's their job to sort of, make that price. If you're in a falling market, of course your price will be skewed accordingly. If something's just dropped 40% on a rumor, you probably want to skew it so that you'd rather buy versus sell. And that's the job of a market maker, and that's their job to risk manage it. But what about the risks that are out of a market maker's control and are introduced because of actually the fact that we're completely decentralized and completely on-chain? And I don't know if this even is a segue into, but we talked about the fact that you were building, or you mentioned briefly you were building on the blockchain. One of the topics that I'm very curious about is this topic of front running orders, especially from a more liquid external to blockchain market. What can you say about the new blockchain you mentioned, or this blockchain that you're building on? Maybe you can give us some more information. And does it address these risks at all?
Yeah, it's very, very dear to my heart as a topic, because when I saw that, when I sort of saw the first decentralized trading and thought, surely I can't just go take a look at the mempool and then just pay Ethereum to be in front of all those orders. Surely that's not what we're doing. And it turned out that was what we were doing. That sort of triggered an alarm bell, which was kind of like, no, we can't build Vega with this, because no one serious will trade if they can be front run by someone who has more money than them. So to me, that was just a massive, massive problem that needed to be fixed. I think you can fix it on chain. There are ways to sacrifice even more latency on Ethereum and fix it by sort of, having a way for the market to kind of add a buffer in effectively to make sure that things happen fairly, or have commit and reveal happen on chain or something like that. There may be ways to fix it to some extent, but what we really decided was that, combined with the performance of the Ethereum blockchain, that all of those solutions were really suboptimal for the kind of liquid markets we're trying to produce. And so we actually hired a researcher called Klaus, who's been with us for sort of a year now, Klaus Kasawi, and he's actually recently, he's about to put out a paper on our website, very, very exciting paper. It's a completely new research into the notion of fairness and what you can guarantee in terms of fairness of ordering transactions in the blockchain. He's done a talk on that recently at one of the events, and I'm happy to send the link around afterwards. But effectively,
was it the Dystopia Labs talk?
Yeah.
Yeah, that was brilliant.
Yeah, and I awesome talk, because there were things I understood better from his research that I didn't fully grasp until I saw that talk. And to me, it's absolutely crucial we get this right, because there's no way that serious trading and volume and liquidity moves to decentralized platforms without it. And so we've done that research. The first version of Vega probably won't have all of that implemented, but we basically now have a protocol and a blueprint for, rather than having transactions ordered by this kind of what he calls capitalistic fairness, as in it's fair if you assume that the person who pays the most should go in front. Instead, you have a concept of market fairness, where you say, well, actually, what we consider fair is that if an order is seen first by the node, then it should be sequenced first, and that means that front running is less possible. If you combine it with things like commit and reveal protocols as well, you can aim with something which is pretty close to perfectly fair. It's not actually perfectly fair. There are some interesting edge conditions, but they're very easy to detect because they involve things that delay things for a long time and things like that. So in realistic trading, you can end up with something that's extremely close to as fair as you can get. And and that means that the front running is less of a problem. And I think it's really important to address those kind of risks in these protocols, because if we want people to provide, to take that risk, if we want a market maker to be willing to put their orders on the book during a falling market, catching falling knives is hard enough, but doing it with your hands tied behind your back because other people are able to front run you is just going to be too much.
Well, the simple reality is there are always going to be good actors and bad actors, regardless of the market, regardless of whether it's on chain, off chain, and off chain it could be more like insider trading or whatever. I mean, that could happen on chain too, but it's made a little bit harder by the fact that you don't know the counterparty, you don't have any information about the counterparty's reputation, and also this concept which is not possible outside of blockchain, the front running concept, and that's a little bit tricky. Let's quickly hop over to Kaine, and I want to see how they think about that issue on Synthetix exchange, and then I'm coming back to you to talk about the blockchain itself, which we didn't speak about yet. But Kaine, maybe you can just make a few comments on how you guys think about that with Synthetix exchange.
Yeah, I mean, it's a tough problem, right? When you don't know your counterparties and no one knows anyone who's on the system, right? And I think it's something that ultimately, if you want a fully permissionless and trustless system, you need to let the market solve, right? It needs to be solved through the actions of the market. And in our case, the way that we are thinking about it is if you've got a market like Bitcoin, for example, where there's a ton of liquidity and it's a much larger market, it's okay for us to provide a lot of depth on Synthetix exchange, because the likelihood that someone is going to be able to skew that market is significantly smaller, given the scale of the two markets, right? Where it gets more challenging is when you have illiquid markets, and we had this issue with Maker, where we listed Maker back in late last year, right, late 2019. And when we listed it, we did a review, and it was trading on a number of centralized exchanges. The liquidity was fairly good. It wasn't amazing, but it wasn't too bad. And then it got delisted, and liquidity dried up in a couple of places, and it ended up where basically all the liquidity was sitting on Uniswap. And then someone pulled a bunch of liquidity from Uniswap, and essentially Uniswap is a pretty soft target because of the constant product formula, right? And so someone worked out and obviously had to look at this and realized that there was actually more liquidity available on Synthetix exchange on the derivatives platform, on the synthetic asset platform, than on the spot market, right? Which is kind of crazy when you think about, at the time, Maker had $700 million market cap, right? And $200,000 could move the thing by $50 million. But that's another problem of kind of market inefficiency. But ultimately, someone was able to manipulate the spot market and go into Synthetix exchange and take counter positions and extract somewhere between $1 million and $1.5 million from the pooled counterparties. What was interesting about the entire kind of process of watching this happen is people could see the trades happening on chain, right? They could see what this person was doing, and they started counter trading them, and liquidity actually kind of flowed back from Synthetix through into Uniswap, and all of a sudden that day, there was significantly more liquidity on Uniswap that day than there'd been previously. But eventually we got to the point where we just said, we need to delist this asset, right? And ultimately that market is just not liquid enough. And that's where I was sort of talking about, I guess, the difference in approach between what we're doing versus, say something like UMA, where they want to have, super exotic style assets, right? Where the market can, have zero liquidity at all, and they're going to kind of bootstrap that liquidity on chain, from scratch, right? As opposed to us, where we're kind of siphoning off liquidity from these large scale markets like BTC and ETH and various other places. So we're constrained in what we can support because we need there to be a lot more spot liquidity than what we've got. Eventually we can solve that in some other ways, but in the short term, we're sort of reliant on very highly liquid spot markets.
Okay, understood. Barney, I think now over to you. Just I interrupted you earlier because I wanted to get Kaine's perspective, but maybe you can tell us a little bit more about the blockchain you're building Vega on, and what advantages it will bring.
Absolutely. So one of the things we sort of decided quite early in the life of Vega was that there are a number of different exciting things going on in crypto. There's certainly the ERC20 and the asset tokenization, and now DeFi as well, which sort of came along after we first started building it in some ways, and it sort of took off. But on the Ethereum side, but equally, still most of the institutional trading in crypto happens in Bitcoin, actually. So to decide where to put this and what we wanted to do would have been quite difficult anyway. And then there were the sort of fairness and other problems with blockchain. So the solution we ended up with was that actually we should build a blockchain that's optimized for trading and optimized for derivatives. That means we can run our risk models on the bare metal. They don't have to kind of, they're not constrained by the Ethereum virtual machine, and the gas price means we can have orders being free to place. So instead of people having to pay to give you market price signals, you actually can accept orders for free, and we can use kind of proof of work based spam protection to prevent people just shoving tons of orders in. And so we have a lot of advantages from doing that. And what we've done is we've built the core of the Vega trading engine to be blockchain agnostic. Really, it needs to know that I've got a block which contains transactions there, and submit order, cancel order, amend order, propose market. There's about 13 or 14 core transactions that basically power everything, and they're sort of listed right up the top of the white paper. And we make that blockchain agnostic so that it can take anything. And then we go and look for the best place to put this. And what we ended up with is we're currently building on Tendermint, which is the same underlying consensus layer that sits behind Cosmos. Large part of that is it's got a really good, easy to understand sort of the programming and development model. The architectural model of it is very sensible and very useful and easy to build on. But also at that time, it was by far the closest to sort of being a mature production-ready blockchain of any of the kind of consensus libraries that were out there that could do what we wanted. So we're building on Tendermint. We're actually working with Tendermint to investigate improving Tendermint to be more modular so that we can actually improve, add things like classes research in, and whether that becomes an official part of Tendermint or a fork is a difficult question at the moment, but we'll find that out over the next few months. And then in the long term, I suspect in the very long term, because algorithms improve and new research comes along, because there's so much money in trading, in the very long term, what I really expect is that it will be worth someone's while to actually build a new, faster back end for Vega based on some of the latest stuff, and actually, to upgrade from the Tendermint technology to something that can do more transactions a second, lower latency, or whatever. So in the long term, I expect that to change. But because we're building a blockchain that's just Vega's blockchain, secured by proof of stake tokens, although to the point, Marouane's point earlier, the tokens actually are not used in trading. The revenue to the token holders turns up in the currencies that people are trading with, which is an interesting dynamic in terms of the valuation of the token and how things work. But the important point is that the tokens are used via the value of those revenue streams to secure the capital in the network, but also that the network is devoted only to providing a blockchain that's optimized for fair and efficient trading and for running and margining and settling these products. So hopefully that answers your question, but if there's anything else you'd like to know, let me know.
Yeah, no, that's very interesting. So, I mean, on the subject of tokens, so Vega will have a token at some point, and that token will be a governance token mainly?
Effectively, yes. So governance and staking for the validators.
And staking for the validators, okay. And so, okay, I mean, when is your sort of mainnet launch plan?
So we are aiming to be in a mainnet alpha, which will have some sort of protocol limitations designed to reduce risk for people trading on it, and also to allow us to iterate with fixes and new features faster for the first sort of 6 to 12 months. But we're aiming to be live in a mainnet alpha towards the end of this year.
Okay, awesome. So now I'm going to jump back to a topic that I wanted to touch with both of you and Kaine, and that's on price feed. So the way I see it is your design potentially enables Vega Protocol to actually become a price feed itself. Because market makers are incentivized to provide liquidity and in very illiquid assets, and so derivatives. So what Vega might enable, which I think is very fascinating, is that we could have on-chain prices for derivatives as a second use case to your protocol. Would you agree to that?
Yeah, definitely. And in fact, two things that I would really like, for Vega, and obviously, one of the things that's kind of not the primary use case to start with, but potentially is a future thing, is also Spot. And so the two things that I think would be really nice is if a lot of the protocols we see today, in order to be functional in things like constrained environments of Ethereum, they effectively rely on off-chain sources of liquidity and price. And if we could actually have on-chain liquidity and pricing, so where we remove that crutch where DeFi is dependent on a big BitMEX or Binance or whatever it is to have liquidity and pricing, then I think we're in a much healthier place as a decentralized ecosystem. And I think that's something I'm very keen to see.
Well, the only way to do that is to move or to port the liquidity over from CeFi to DeFi, which is otherwise we will continue to be dependent on, or at least the better price feed source will always be CeFi. But from what I'm seeing right now, there are only two like really true, completely decentralized. I might be forgetting a couple, but from what I can see, the two main truly 100% decentralized price feed sources right now are Kyber Network and Uniswap. But in the case of Uniswap, there will always be a time lag. V2 will be interesting because of the way it's calculated, but in its current form, there's always a time lag because it kind of makes the wrong price to protect the market maker in big volume situations. But it will always end up at the right price after the fact because of arbitrageurs.
Yeah, but then you still need another source.
And so I think that it is. Sorry?
Just with arbitrageurs, you still need.
What did you say, Barney? I missed that.
Sorry, is it?
I don't know. I cut off. Sorry. Can you just say that?
Yeah.
Yeah, I'm hearing you again now. Yeah.
Good. So I was just saying with arbitrageurs, the problem is you still need another source of price. So if you're a Uniswap and you're an on-chain source of price and you're entirely decentralized, you're actually your protocol might be entirely decentralized, but your price source is still dependent on something else, which we have to assume at this point is still centralized to provide a price to arbitrage against. And so, one of the things that we think is that having automated passive market making is useful because it allows you to attract more liquidity into market making, but you also need a way to get primary sources of price into the decentralized protocol to bring that pricing on chain.
Yeah, especially. Yeah, and so you still are dependent on external pricing, especially when it comes to margin calculations. And so what will be your source of price?
So depending on the product, we're not necessarily dependent. So obviously, if you think about the standard exchange model with this sort of limit order book, the price is considered to be the price on the book. And what we're aiming for actually is that in general, for most markets, minute to minute, mark to market doesn't require an oracle. So what we actually do is we have a number of mechanisms to protect that. And the first one is the market making. So if you have sufficient market making, liquidity making prices, then they are your oracle and they're financially incentivized not to make bad prices. So that's the first thing. You actually have a built-in mechanism that sources prices. Then we have two other sort of market protection mechanisms that are designed to ensure that we don't end up in a bad place. And the first one is what you call liquidity protection. So if the market does not have enough liquidity to believe it has a good price, and that also from a risk perspective it's safe, the market can enter an auction period where effectively orders are still placed, but rather than uncrossing and matching those orders straight away, you're actually sourcing liquidity into the book and you're sourcing price information before deciding to uncross that auction. And they're the trigger of when enough liquidity is there and enough commitment is made that the market is safe to reopen, then the auction can uncross. So first thing you find is that we trade latency effectively for better prices in the case of low liquidity. We say, well, we can't be confident in the price now, so we're going to enter an auction until the conditions are met. And then the second one is a price monitoring type thing. And actually, this is the kind of thing that probably would have helped Uniswap in some of the recent sort of exploits that have involved them, because if you know how much the price is moving and you've got the kind of risk algorithms we have, you sort of know the volatility, and so you know what's an expected move and what might be real but might also be a consequence of low liquidity or of a very large trade. And when you see that kind of large amount of move, what it makes sense to do in our view is to do a similar thing and to go into an auction and say, well, let's check on this price before we print a bunch of trades and revalue a bunch of positions with it. So instead of printing those trades at that price, we actually put the market into an auction, and it can be very short. It can be a couple of minutes initially, and effectively say to everyone in the marketplace, something that would have made a big price move has happened. Like, if that price move is true and you don't agree with it, get on the other side of it and make some money. And so what that does is tell everyone that that's happened, give them a chance to come in and temper the price move, and then we get to find out at the end of the auction whether or not the real price is the one it would have moved to if you just sort of blindly executed the order that came in, or whether the real clearing price for that market is actually not such a big move after all. And by doing those things, we are pretty confident that when we do print trades and print prices, we can mark-to-market positions for our risk management based on those prices. But you do still need a price source or an oracle, and for many times derivative at settlement, because the only reason that everyone is kind of willing to make this fiction of the price be real is because at some point they think if they're left holding it, it's going to settle to something. It's a bit like the oil price recently. Like, what happens is everyone suddenly realizes that if they're still holding a long contract at this point, they're going to get some oil, and it needs to be the same. So you either need a physical settlement, or you need a kind of oracle, so that the participants in the market know that if they're long at the end of the market, they are going to be settled in the right way, and that sort of causes them all to act in the economic rational way. And actually, Tamlin, our sort of ex-trader and sort of head of markets and product type stuff on the team, put a really good post on our community forums recently explaining some of the ins and outs of that, and the relationship between sort of derivative settlement prices and oracles.
Awesome. Marouane, I saw you wanted to jump in there with a question or a comment. Please go for it.
Yeah, well, actually, I was thinking of BitMEX. There were like long periods of time where there was a pretty big price difference between what they have and the sources that they were using as oracles, other exchanges. So this auctions mechanism, basically what you're trying, or correct me if I'm wrong, you're trying to create an arbitrage opportunity for people who are going to be taking the other side of the trade, or is it something else?
Yeah, pretty much. I mean, if you think that that the price that would have got, if you think that the price that the auction would currently close at is lower, if you think that if the price happened now, then everyone is going to look at all the price of this thing and going to buy it back up, let's say, then the obvious thing for you to do is to get in with an order, which when they come and buy it back up is going to make you a profit. And so, you're basically, it's almost like a pre-arbitrage, because rather than actually lock in an arbitrage, you're looking at the price and going, if the price is right down there, I am willing to come in because actually I believe it's that. And so it's basically swapping that latency. If that price was going to go back up anyway because people would see it had dropped, if it's a large price, which we have enough reason to believe is unusual, that it's actually worth checking, then rather than let it drop, let everyone be reevaluated and potentially liquidated based on that drop, and then discover that everyone's going to flood back in and the price is going to bounce up. What you do is you go, well, that was a big unexpected type of move, let's not do it, let's just have an auction so that people can come in and balance the price out. So that's kind of how it works. And then just to go back to your point about, it's interesting, BitMEX has differences to the price of the Oracle exchanges, but look at Bitcoin exchanges, they can differ by big amounts because of, the levels of demand in different countries and the difficulty with liquidity moving across like regulatory boundaries and things. So, the idea that a price, one market is exactly the same price as another, sometimes it has real, basis in reality as well, and sometimes it is a temporary aberration that'll be sort of fixed by arbitrage.
So on that thought, let's jump over to Kaine. Kaine, I imagine you guys are constantly thinking about evolving your price feed and ways to improve it. Do you want to give us some insight into your latest thinking on that and what you guys are working on at the moment?
Yeah, I mean, so we made a decision almost a year ago now to switch over to Chainlink for our price feeds, and when we talk about, I guess, moving price discovery on chain, there's markets that we're talking about, like equities markets, where that's just not likely to happen in the short term, right? Realistically, in the long term, I think we're all bullish on.
Well, say there's one big problem. It's not a problem if you have, market makers, but the fact that equity markets are typically only open for, less than half a day, whereas tokens and, crypto is a 24/7 market, versus a half a day, 5 days a week. So, you're going to naturally have liquidity from arbitrageurs dry up instantaneously the minute the market is closed. But that's when you really need the real market makers, not the arbitrageurs, to come in and be comfortable making markets in the dark, basically.
Yeah, interesting.
Yeah, I mean.
Right.
Well, let's let Kaine continue on that. Barney, we'll get your insight in a second. Go on, Kaine.
But yeah, I mean, again, like I think the structure of the assets that we're creating is, this purely synthetic asset. It just tracks the price of the Oracle from some other spot market, right? There's no price discovery that happens on Synthetix exchange, right? So, when the market shuts down at 3 p.m. or whatever, or like for example, we've got a synthetic Nikkei index, right, that we're tracking. When the Nikkei shuts down for lunch, there's no more price. That's it. It's done, right? It pauses, the market's halted, and we don't continue with trading, etc. So again, we're 100% dependent on pulling whatever the spot price is, or whatever the price in the futures market is, or the commodities markets, or wherever it is that we're getting the price from. We're just 100% dependent on that. Maybe in the future, if we have sufficient liquidity, we could allow some kind of 24/7 trading. You can imagine a scenario where you're allowing people to trade, synthetic Tesla that's totally tracking the price of the market in New York, and then when everyone goes home, you switch it over to bilateral mode and let people continue to make up market all night long. That's definitely something that could happen, but the value prop that we offer of getting exposure to those assets while the market's open and knowing that it's going to track the price is kind of the value prop, right? It's not that we're creating price discovery in this asset, in some alternative market on chain. Again, I'm super bullish that a lot of this stuff.
If I wanted to just let's say Synth was closed for market making because the stock market was closed. There's nothing to stop me coming out and saying, hey, I'm going to make a market in Synth, right?
Totally. Yep.
And settling it on, it doesn't, the tokens are transferable outside of the network, so why not? So it's 100%. Just you as in Synthetix will not make that price.
Correct. Yeah. Okay. So you could take that price and I guess where it changes, right, is the service that we offer is the ability to turn up with any synthetic asset and reprice it based on the oracles, right? And you pay at the moment a 30 bip fee for that service. That's what the SNX stakers are essentially enabling, right? So if you said, hey, I've got this synthetic asset and I can't convert it because the market is closed back to some other synthetic asset, right? You've got synthetic Tesla and you want to convert it into gold, but the New York Stock Exchange is closed, then you are sitting there and you basically could go and sell it to someone for whatever price you can get in the market, right? But the reality is that there's probably not going to be that much liquidity, right? You're probably better off just waiting till the market reopens, and then you're going to get, whatever the spot market is at that time. But it is definitely possible that over time, some price discovery could start to emerge, and markets could kind of spontaneously arise. I think just, for all kinds of reasons, some of which Barney's touched on, in the short term, that's probably just not that likely, right? And the thing that we're offering, the service that stakers are offering, is just the ability to know that you're going to get the price of the asset, when it's trading in the spot market.
Okay, this is awesome. So there's one small question I have for Barney, and then one bigger question I have for the three of you, and then I want to open it up for questions from if there are any from our viewers. Barney, I'm just curious, and I think probably a lot of viewers will be curious, because you're building on Tendermint, and I actually haven't looked into, I don't know how much of this is publicly available, to be honest, but how easily integratable and composable will Vega Protocol be as a result of some of these design choices you've made?
Yeah, awesome question, and actually really another important sort of part of our design choices. So Something we haven't touched on here actually that was really key to us was that we did not want to create the assets people are going to trade with. So the idea that you would have to get a US dollar stablecoin issued on Vega to trade dollars on Vega would be a bad plan, and similarly having to like have a Vega wrapped ETH or something would be a bad plan. So what we're effectively doing is we're creating a series of bridges, and then the first one is the Ethereum network. So every validator node in the Vega network will run an Ethereum node as well, which participates in this kind of cryptographically secured bridge where there's a smart contract on Ethereum. You send your Ether or your ERC20s to that smart contract, and then via this bridge, they're effectively available for you to trade on Vega. So Vega's kind of quite integrated to Ethereum, and initially that will just be for assets, but what we will also eventually enable to happen is a smart contract will be able to effectively use that bridge to control Vega in a way, like to make transactions on Vega. So a smart contract entirely without a human intervention could effectively say, deposit some tokens into the Vega bridge contract, request to taking out a position at a certain price level with a certain amount of margin assigned to it, and then that smart contract effectively owns that position and owns the P&L on that position and can close it and amend make new orders and whatever else it wants to do. So you could have a DAO trading, you could take out a position, and then you could issue ERC20 tokens that represent the valuation of that position and close it and automatically send the results to someone. All of those things are possible. The only difference to kind of a lot of the DeFi stuff now is you get a lot of these atomic protocols in DeFi now, which actually, as far as I can tell, have been a source of at least as much headaches as benefits in terms of being able to atomically borrow flash loans and do all kinds of weird exploits. But because Vega's on a different chain, and because this bridge takes time to confirm finalization of the Ethereum block, and then the thing happens on Vega, and because that bridge is not instantaneous, effectively, it's an asynchronous type of thing. So your contract can take on that position and do it, and then the contract's effectively going to get notified of an event on Ethereum when there's an outcome of the thing it's done on Vega. But it's very much designed that Vega is composable into kind of traditional DeFi protocols and into whatever anyone wants. So yeah, very good question. Thanks.
Awesome. Very, very, very good to hear. Now, I think before we go to questions, I just want to ask you, all three of you, to just identify in literally one, 4 or 5 word answers, who are the key stakeholders in your system. Actually, 4 or 5 answers is too short, but let's say very short answers. Who are the key stakeholders in your ecosystem, and how do you align incentives between them? Let's start with Marouane.
We are not yet launched, so I would say that we are going to have a lot of risk underwriters. I think that the demand for insurance is there. So the main thing is to be able to have people who are willing to underwrite the risk and to take the other side of the trade. So that's the main point and most important point.
But I guess the stakeholders would be the token holders, the risk underwriters, and the purchase. The sort of people who want to be insured.
Yeah. Exactly.
Okay. So we will come back to alignment of interest when you guys go live then. Yeah. Kaine, maybe you go next.
Sure. Yeah. So we have SNX stakers, right? Who are the token holders who, if they stake the token, get pro rata right to the fees that traders pay. So there's stakers on one side who are the pooled counterparty, and then there's the traders who are actually using the platform and trading these synthetic assets. And so the traders pay a fee every time an asset is converted, and those fees flow through to this kind of pooled counterparty group that are staking tokens.
Okay, so the stakers and the traders. Okay, and Barney?
Yeah, so we have the stakeholders in Vega are effectively, obviously, the token holders and the validators who are also token holders, but they are performing a specific role as well. The general traders, so people who actually just want to use Vega and are not interested in holding tokens, and the market makers. And there's 2 sort of sets of things we do to align incentives. The first one is around the governance. So one of the very interesting things about having market makers who have a staked bond in the currency underlying their market, underlying their commitment, and also having validators who will stake some tokens, is that these are kind of like, it's a bit like having the two houses in the US government. They can effectively keep each other in checks and balances. So when decisions need to be made on the network where there's a potential for sort of moral hazard in the market making side, those decisions can be made or approved by the token holders and the validators voting. And equally, when the validators are doing things like maybe setting the amount of the fee that goes to them, those can be done by market makers. And so you have a kind of checks and balances system built into governance there, where those two face off against each other. And then, obviously we've talked a lot about the market maker incentives and aligning their incentives both to keep their liquidity on the book at all times by having that bond and paying them out in fees, but also giving them the incentive via the equity-like stake they have in markets to join the market and commit to it early, or even create new markets, because they will keep a very large percentage of the fees even if the market grows. So if you come in with a small market making commitment to a small new market, and it becomes hundreds of millions of dollars daily traded notional or whatever, then you're still going to have a relatively large stake of the fees coming out of that much larger trading volume. So you have this kind of, a bit like being a seed investor in a company. Your revenue is going to grow with that market even without putting more in. So you have very strong incentive to create things and back things early that are good for the network. And then for traders, obviously, the incentive for traders is really, we want them to trade. Pretty simple. We want them to trade, and we want them to meet their margin calls. And so obviously the downwards incentive of having your margin confiscated if you don't meet the margin call or close your position is what on the one side, but then on the other side, the way that the incentives that set the fees are built is that effectively the other participants have an incentive to reduce the fees to the lowest level they can be, because that will encourage trading volume. And so that's the final sort of piece of the puzzle, is you want to pay out whatever incentives you need to keep the network secure, to keep it running, and to keep the liquidity there. You don't want to pay any more fees than that, because otherwise you get into the kind of problem that we have with centralized markets. You want to minimize those fees to just the real cost of that liquidity, the real cost of running the network, and then pass the benefits on to the traders, who will then do more volume. So that's kind of how we think of it.
Okay, great. Kaine, I just, an afterthought after you spoke, what about the token holders? Because the token holders in your ecosystem, because a token holder in Synthetix is not necessarily a staker. So how do you think about that? I know that there's obviously, there's this inflation program that you launched for 5 years that incentivizes staking, and there's a share of fees. I guess, yeah, would you, I was surprised, I guess by stakers, you meant token holders and stakers. So there's actually three. I mean,
active token holders, right? So, there's obviously passive token holders, but someone who's making a market on, Polo or something like that is providing a service to the network, but they're not necessarily, participating in the network itself, right? So if you're just a market maker sitting on a centralized exchange making a market on SNX, we like you, but you're not necessarily contributing, right? So you're not going to. Sometimes we like you. Depends on how you act, but you're not contributing to the actual kind of mechanism itself, right? You're not providing liquidity. You're not you're not an active participant in the network. So we took a very hard line, and this is something I think we've probably talked about in our Discord even before, about buyback and burn models versus cash flow models, et cetera, and paying sort of fees directly to people who are actively staking versus burning tokens off the open market, and the efficiencies of that, and whether it actually actively incentivizes people to participate. And there's all kinds of crypto economic rabbit holes you can go down there. But the view that we took was very hard line, that if you're just passively holding the token, maybe you hope that there's some kind of token appreciation or something like that, price appreciation, but you're not going to get the actual economic incentives that are built into the protocol itself.
Okay, awesome. So I'm gonna take a step back now. We are entering into question time. If there are any questions, I'll wait for Bryce to see if any of those are relayed over to us. In the meantime, are there any topics that you guys want to bring up, or comments that you want to make that you have observed during this panel, or surprised you, or didn't surprise you, or recent observations that you want to talk about?
Well, actually, we were also supposed to talk about the next steps, the next products, derivative products that we could have in the market. So I'm curious about the type of products that you see coming next, both you, Kaine, and Barney.
I'm happy to do a bit of gazing at that one. I think something we're very curious about that too, and one of the things I think is super exciting is creating a way to make it sort of permissionless and make it so that anyone can innovate, because I think that's where you get the cool stuff. But in terms of crypto, I think there's so much that already exists. There's so much innovation that exists in the financial system and product innovation that actually is not yet possible on decentralized markets, that I think bringing more of that to crypto is the right thing. And I think there's a great thing that Matt Levine, who's a Bloomberg commentator, always says, which is like the people in crypto finance and DeFi are just doomed to learn every single lesson that regular finance learned, but kind of sort of at rapid fire, but over like 300 years of history. And so I think something I've noticed, and I think it's starting to happen over the last few months, is you got last year, everyone DeFi was perfect, and it was the thing everyone was talking about for all kinds of good reasons, but it was no one was looking under the surface. I think people have started to look under the surface now and start to see where it needs improving, but also where we can learn from regular markets. And I think connecting real markets up to DeFi, getting DeFi protocols really stress tested, using these protocols to really do stuff, and getting them in front of real traders and real businesses who can use them to hedge or want the exposure, and actually just finding out what we still haven't worked out and finding out where the cracks are, and just really kicking the tires and really moving away from the kind of, well, you're going to get some of the money because you're offering a return and everyone's got ETH lying around, moving into really finding those use cases and really kicking the tires and getting the traditional finance lessons in is something I'm super excited to see happen.
Okay, we're getting some questions coming in, so I'm going to start reading them out. The first question to each of the three of you: what would you guys be doing, or what would you love working on if you were not working on your project? Who wants to go first?
I mean, we tried to build a stable coin, right? Like that was the original product that we set out to build, and it's kind of funny how it's come full circle, and SUSD, which is the synthetic US dollar that we have now with the sort of direction that Maker's gone and permissioned assets and MCD and everything, we've kind of been forced into this position of actively pushing that stablecoin again. So I've found myself more in the stablecoin game again, I guess, over the last few months than we necessarily thought we were going to be, which I think, we always had a view that we needed as much experimentation in terms of, stablecoins and things like basis and, other approaches that unfortunately never really reached escape velocity. We're kind of unfortunate that we didn't get that experimentation. So, I'd probably be working on a stablecoin, I guess, and I might end up coming back to one inadvertently. So,
awesome. Marouane, do you want to go next?
Sure. Well, it's not the right timing for this question. We are just starting off, so I'm more like focused on what I'm doing right now. I didn't have time to think about what I could have been doing otherwise. So I'm on it. The idea is to try to build something that allows to secure the whole experience in DeFi and related in general to blockchain. So we're trying to build it.
And Barney, maybe curious to hear what you would be doing.
That's a really good question. I don't know. There's a lot of things I think about, but probably something to do with sort of data and information. I think like one of the things that excites me about decentralization is kind of giving everyone the same tools that professionals have and sort of breaking down those barriers. And I think a lot of that is about how you get data and information out and how you present it to people. So, and I think a lot about our UI and how we can build tools in Vega that give people that. And I think if it wasn't Vega, I would probably be thinking about how crypto and how decentralization can enable that in other ways.
I might even try to answer that question myself. I would be doing a lot more yoga. I would be on the beach a lot more. But actually, I would also probably go back to managing money. I think I think trading and investing is fascinating, and it's something that I always loved doing in a previous life, and I think that was also one of the key drivers for me was in terms of setting up Melon was when I actually eventually tried to set up my own long-short equity fund and failed because of some of the unbelievably high barriers to entry in finance, and a lot of the problems that you guys very well articulated in this call, which are brought on by high costs or intermediaries in the space. So I guess if we all succeed, I can go back to doing that from a beach somewhere. Anyway, we have a second question. This one is actually directed to Kaine. So do you have any idea of the profile of the average user of Synthetix? Which synths are they using the most? And is there any pattern that you can derive?
Yeah, I mean, I kind of touched on this briefly, but crypto degens basically, right, at the moment. DeFi speculators and pretty hardcore crypto people is really the profile. We haven't even, I would say, up to this point, we've been live for a long time, but we haven't really broken out even of the core DeFi group into, say, like, the BitMEXs and OKEX futures and things like that yet. So, they're pretty long biased ETH, as you would imagine. There's a lot of short TRX and XRP. I mean, one of the things that we're doing at the moment is a layer 2 optimistic rollup trial. Speaking about fast blockchains, we might be able to make the one that we already have a little bit faster. And the demo has been quite interesting because we've got, I think, a much wider range of traders to kind of test it out, just because it's a bit of a demo, it's free to join, etc. And so it's been interesting to see the kind of skew of the synths that they've been holding has been quite different to what we see on the actual L1 exchange. So, it's something that I think is, we've got a little bit of adverse selection at the moment, but, it is getting better as we get a wider range of traders.
Okay. Am I still on mute? Oh, no, I'm not. Great. Thanks for that, Kaine. Next question is, this is good. Can you give us an example of a novel or original new derivative that we could see in the future? Maybe, Barney, I'm going to give this one to you, but feel free if anyone wants to jump in afterwards.
Yeah, I think let's give a couple of examples we've thought about recently. So one example would be kind of in the crypto space. Something that we've been thinking about a lot is the kind of derivatives you can put around mining. Some people talk about hash rate futures. I'm a little unsure. I think everyone who wants those might be all in one direction of that trade. But something I think is interesting and similar is kind of mining income swaps. So effectively, I've got all these big physical machines that mine Bitcoin. Maybe I want to swap the income from mining Bitcoin for the income from mining Ethereum, and actually, then you've got people on both sides. So mining income swaps, I think, could be very, very interesting as the kind of the fortunes of those kind of networks change. And then, like, very responsive derivatives. I think, looking at the COVID situation that occurred, it quickly became apparent that there was a huge range of outcomes that people believe were possible, and then there were a huge range of outcomes that even within that might happen depending on how effectively different governments, and societies responded. And so, to be able to very cheaply and quickly with infrastructure that already exists, stand up a market that says, I am at risk if the response is bad, either my business or me personally, and actually create a market around that, get it tradable, and get the people who believe that you should run around outside and continue as if nothing's happened, trade with the people who believe there's a bigger risk, and actually allow people to offset and hedge based on their belief about those things. So I think that reactivity and the ability of society to spring up a market when something like that happens very quickly is the kind of thing I think would be really novel and very interesting.
Awesome. Okay. Thanks for that, Barney. So this question is a little bit trickier, but nothing that is above your heads. There's a capital efficiency question that's, so the analogy being made is Curve introduced, so Curve introduced a capital efficiency versus Uniswap in the sense that they enabled liquidity and lending together. will derivatives also enable similar flows, increasing capital efficiency? I actually think you might have partially answered this question or fully answered this question earlier, Barney, but maybe great time to re-highlight the point, because I thought it was one of the fascinating points you made about Vega, actually. Do you want to go for it?
Yeah, sure. So I think capital efficiency is really important. Like real trading, as you want to define it, as traders who have a real reason why they need to be long or short in serious size, for instance, are not going to move to these platforms if it's clearly much less efficient. And so we think about that in lots of ways. We've got the kind of netting of things. You've got being able to run sophisticated risk models, and really interesting things happen there because you might assume that because everyone is pseudonymous, you need to assume there's greater counterparty risk. That is true, but most platforms that exist today only reevaluate their margin like daily. You get a phone call at 4 p.m. if you need to make a margin call or whatever. We reevaluate the margin every second, so we can. One thing increases the risk, the pseudonymity, but the other thing actually allows you to deal with it much more quickly, and so your time steps are smaller, and so that actually offsets. So we think about that all the time, and actually another concept we have is the concept of a risk universe. So rather than just one product, you can have correlated products which offset the capital needs. So if you have a series of options or a series of futures with similar or the same product and the correlations are understood, then they can be configured into a risk universe together, and then you can actually have margin, long one option offsetting at least partially margin that's short another option. And so I think, I agree. I think derivatives and the right platforms, whether it's derivatives or not, will allow us to increase capital efficiency. And the goal is really to work out, with using the economic incentives we have, is to create a system that gives you the highest possible capital efficiency for a level of risk tolerance that the market says they have, because you're always going to trade off how much capital they want versus how likely everything is to blow up. And if you know the story of Lehman Brothers and all the others in 2008, they just signed some contracts and forgot about them and then blew up. And so you probably don't want to go all the way that direction, but allowing the market to actually customize their tolerance for that kind of thing, and people to go in with eyes open with good information about it and actually select the level of risk and get the right capital efficiency for the right markets, I think is just an area we're just beginning to explore.
Yeah, I think that's the key. The key point there is really that it's the offsetting of positions that really enables the capital efficiency with the Vega design. And Marouane, I think I know the question was not specifically on derivatives, but in the case of, it's a good question. So it's one that we should consider on all three of these protocols. We talked earlier about initially on insurance protocols, capital efficiency being tough because there isn't enough data to judge risk accordingly. So the best way, is to start off 100% collateralizing everything and then move towards a less collateralized model as we collect more data and build more confidence in our modeling. And then Kaine, I think out of the three of you probably have the least capital efficient model because of the 800% collateral requirement. Maybe it would be interesting to think about how you think about capital efficiency going forward in order to scale Synthetix.
Yeah, so I think we've got for the SNX token, the capital efficiency is pretty low, but I suppose on some level, the opportunity cost of what you could do with your SNX is also pretty low, right? It only does one thing, which is to provide collateral for this network, right? So, you could sell it and go and do something else, but crypto people crypto markets are not necessarily the most efficient thing in the world. I think the interesting thing about the example that was used was Curve, right? And Curve being able to make manufacture or construct more efficiency by putting it into two protocols and doing two things with the same money at the same time. There are practical implications to that are not always immediately obvious. So one of the interesting things that we've sort of seen is when we launched the Iron pool, which is a form of the Curve pool that was using Aave as the deposit mechanism, we were incentivizing liquidity into that. And so what happened is there were people who were depositing, into the curve pool, and then the SUSD was getting deposited into Aave and was therefore, able to be borrowed, right? So then they would put up more capital in the form of USDC or ETH or whatever, take more out, and then, jump. And they were essentially levering up to get access to, more liquidity into the curve pool, which had interesting implications when it was then unwound and we moved to a different curve pool that didn't have Aave as the backstop of this lending protocol. And there were people that were kind of trapped in there and had to wait for liquidity to be put in to be able to unwind that position. So, it's not always necessarily the most sane thing to do to just say you can take this, there's all kinds of proposals around using Uniswap LP tokens to be able to then deposit into Aave. And, I think as much as it maybe makes things more capital efficient, there's tail risk that you need to factor in.
I'm actually, so I'm really surprised you didn't mention, I read that you're going to be introducing new forms of collateral going forward. So wouldn't that essentially also reduce capital requirements? If they're,
yeah, exactly. So
if they're potentially less volatile than Synthetix?
I mean, they'd struggle to be more volatile, but yeah. So like ETH, for example, right? Using ETH as collateral, we'd be able to kind of use what's become the industry standard of 150%, for example. So we have a trial that's running at the moment with ETH collateral at 150%. Theoretically, you could get it lower. You could get it down to 110 or 120 because you're actually borrowing synthetic ETH against the ETH. So there's no sort of currency fluctuation risk or margin risk there. So there are ways of doing that. I think adding additional assets, but as we've seen with Maker, you have to be very careful about what assets you add and the implications of that. There's always, I think one of the things that we've sort of certainly learned, and the Matt Levine example is, I read that daily, and every day I'm reminded of just how crazy it is, some of the stuff that we're doing, and the lessons that, you kind of practically learn rather than, theoretically learn. But, we have practical implications that are sometimes hard to see around corners, right? Like, things just hit you and you're like, oh, of course, that's obvious in hindsight. But, it is very challenging sometimes to know what the implications of some of the things that someone else is doing, even while you're not paying attention, right? Like there's some other protocol that integrates, SUSD, and they're doing something weird with it, and you don't realize, and all of a sudden, there's someone can just pull up a $10 flash loan and rip it out of this other, this one contract and then dump it in here. So it is hard to kind of be aware of all of the surface area, simultaneously, and the surface area in DeFi gets bigger every day. But yeah, it's just a challenge, I think, of being live and actually being in production on mainnet. So
yeah, absolutely. We have another great question. Are you guys looking into ETH 2.0 compatibility yet, or are you just relying on the transition being smooth? And alternatively, I guess is more for you, Barney. Are you, or actually for all of you, are you evaluating compatibility for other platforms?
Yeah, we definitely are looking at other platforms as well. We have kind of partners and investors who are heavily invested in Bitcoin and RSK ecosystems, and we're very interested in getting connected into that. Equally, there's a lot of demand we've seen from some of the people we talk to about derivatives that they can do on XRP type transactions. So we've been doing a little bit of thinking about that, and then the other thing we're thinking about is the kind of the cross-asset, cross-chain stuff. So actually, is there someone building a protocol where we can integrate with that protocol, and then it solves cross-chain in an even easier way to enable even more chains? I think it's kind of a bit of an 80-20 rule here. If we get the couple of chains where most stuff is happening, then that's going to cover most use cases. And so we do have to balance those things, but I think we're very interested in going where the money is, where the liquidity is, where the demand is, where the trading is. We want Vega to be usable with, whether that's on Ethereum or Bitcoin or somewhere else.
Awesome. Thanks for that. Marouane, have you guys put any thought into that yet, or one step at a time?
Yeah, we are focusing mainly on Ethereum. Well, we don't have the same. Being an insurance protocol, we don't have the same scalability issues as trading protocols. Basically, we don't have we don't need a high throughput. We don't need to be able to manage a lot of transactions per second. So it's a different approach. We are really focusing on building something that works on Ethereum and being able to after that cover as many risks that can come from different blockchains. And this is the case for the slashing risk. It can be also something we can do with Vega Protocol, like provide this insurance layer that Barney was talking about. These kinds of things we can do them, but without moving out of Ethereum and while staying on Ethereum.
Awesome. And Kaine, maybe we can finish up with you on Synthetix plans.
Yeah, I mean, we certainly wasted a little bit of time in 2018 exploring some other blockchains like EOS, and I think a lot of protocols have done that. But I mean, personally, I'm probably as close as you can get to an ETH maxi while still holding Bitcoin. But my pretty strong view is most of the activity is on Ethereum, and I think things like L2 scaling, like the OVM demo that we're working on, and things like optimistic rollups and ZK stocks are going to more than cover us for the interim period, however long that may be, before we get to ETH 2.0. And for some use cases, ETH 1.x may be sufficient, right? And you may not even need to migrate across. So, I'm not too concerned about it. I don't think unless you're building something that is a very specific use case, the roll your own blockchain thing is a dangerous path to go down.
Yeah, I would. I guess we can just close with saying we also wasted a little bit of time last year. No, the year before last, actually, also 2018, on exploring interoperability and other solutions. And I think ultimately it is too early. Although we're keeping a very close eye on everything going on, but it's also such a fast-moving, fast-paced, changes that it's hard. It's almost not worth the time invested to pay too much attention until they're all in a bit more stable state, or even in some cases on mainnet. So yeah, I think we're also watching the space very closely and very excited to see what will come. But anyway, I think we're now at the end of our time. I want to thank you guys all for being amazing panelists and for all the color you guys had to shed with my questions. As I said at the beginning, I really hope that you guys are able to follow solve all the tough problems you're trying to solve, because we need products like that to be able to, there's a huge demand for products you're all building from our users, and so it would make me very happy to see you all do very well and bring us Synthetix and derivatives and insurance across the space. So yeah, so I think we can end there. Thanks, guys.
Brilliant.
Thanks,
Thank you very much.
Appreciate it.
Day. Awesome. Take care.
Yeah, thank you.
Bye, guys. Take care.
All right.